It didn't take a war. It didn't take decades of slow decline. It didn't even take a full week. In just 3 days, an entire country's banking system, once celebrated as a miracle of modern finance, collapsed under its own weight. The question is not just how it happened, but how almost no one saw it coming. Because this wasn't a poor nation struggling to survive. This was a wealthy, developed economy, praised by analysts, trusted by investors, and admired for its rapid rise. So how did Iceland go from financial superstar to near bankruptcy almost overnight? And, more importantly, could something like this happen again somewhere else? To understand the collapse, you have to rewind to a time when everything seemed to be working perfectly. In the early 2000s, Iceland was not known for financial power. It was a small island nation, with a population smaller than many cities, built on fishing, aluminum exports, and a tight-knit economy. But something began to change. A wave of privatization transformed its financial system. The government sold off its major banks, opening the door to aggressive expansion and risk-taking. Among these banks were Kaupthing, Landsbanki, and Glitnir, names that would soon become infamous. At first, the transformation looked like a success story. These banks didn't just operate locally. They expanded rapidly across Europe, borrowing heavily from international markets and investing in assets around the world. Their balance sheets grew at a speed that seemed almost unreal. Within a few years, the total assets of Iceland's banking sector became several times larger than the country's entire economy. On paper, it looked like Iceland had discovered a shortcut to wealth. But underneath that rapid growth, something far more fragile was forming. The banks were borrowing short-term money, often from foreign lenders, and using it to finance long-term investments. That mismatch created a hidden vulnerability. As long as credit was cheap and confidence remained high, the system could continue expanding. But if trust ever disappeared, the entire structure could collapse in an instant. And that's exactly what made the situation so dangerous. The success of the system depended entirely on something that cannot be guaranteed: confidence. At the same time, Iceland's currency, the Icelandic krona, became a key part of the story. High interest rates attracted foreign investors looking for better returns. Money flowed into the country, strengthening the currency and fueling even more growth. But this also made Iceland deeply dependent on external capital. If those investors ever pulled out, the consequences would be severe. For a while, the warnings were easy to ignore. Credit rating agencies continued to give favorable assessments. Analysts praised Iceland's innovation. The banks reported strong profits. And as long as everything kept growing, few people wanted to question the system. But cracks were already forming beneath the surface. Debt levels were rising rapidly. The size of the banks compared to the economy was becoming dangerously large. And perhaps most importantly, the system had become too complex and too interconnected to fail safely. Then came the turning point. In 2008, the global financial system began to tremble. What started as problems in the United States housing market quickly spread into a full-scale crisis. The collapse of Lehman Brothers sent shockwaves across global markets. Suddenly, trust disappeared. Banks stopped lending to each other. Liquidity dried up. And the entire financial system entered a state of fear. For Iceland, this was the moment everything changed. The same global markets that had fueled its growth now became a source of pressure. Foreign lenders began to pull back. Access to short-term funding disappeared. And without that constant flow of borrowed money, Iceland's banks faced an immediate crisis. They needed liquidity, but there was none. The first domino fell when Glitnir announced that it could no longer refinance its debts. The government stepped in, attempting to stabilize the situation by taking a majority stake in the bank, but Instead of restoring confidence, the move triggered panic. Investors began to realize that if one bank was in trouble, the others might be too. And because the banks were so large compared to the national economy, the government didn't have the resources to fully guarantee them. What followed was not a slow unraveling. It was a rapid collapse. Within days, Landsbanki and Kaupthing also failed. The entire banking system effectively imploded. The speed of the collapse shocked the world. A financial empire built over years had disappeared in less than a week. As the banks fell, the consequences spread quickly through the economy. The Icelandic krona lost a significant portion of its value. Imports became dramatically more expensive. Inflation surged, businesses struggled to survive, and ordinary citizens found themselves facing a crisis they had not created but could not escape. Savings were wiped out, loans became harder to manage, and trust in the financial system was shattered. The impact didn't stop at Iceland's borders. One of Landsbanki's online savings platforms, known as Icesave, had attracted depositors from countries like the United Kingdom and the Netherlands. When the bank collapsed, those depositors suddenly faced uncertainty about their savings. This led to diplomatic tensions, legal disputes, and years of negotiations over who should bear the losses. What had started as a national crisis quickly became an international issue. In response to the collapse, Iceland took a path that surprised many observers. Instead of fully bailing out the banks, the government allowed them to fail and focused on protecting domestic depositors. Capital controls were introduced to prevent money from leaving the country. The economy contracted sharply, but over time, this approach allowed Iceland to stabilize and eventually recover. The central bank played a critical role, but its options were limited. Unlike larger economies, Iceland could not rely on massive financial reserves or global currency dominance. It had to navigate the crisis with constrained resources, making difficult decisions under intense pressure. International organizations, including the International Monetary Fund, became involved, providing support and helping to stabilize the economy. But even as the immediate crisis began to fade, deeper questions remained. How did such a small country build a banking system so large that it could not be saved? Why did regulators allow risks to grow unchecked? And why did so many investors ignore the warning signs until it was too late? The answers lie in a combination of factors that, on their own, might not seem dangerous, but together created a perfect storm. Rapid financial liberalization allowed banks to expand quickly. Easy access to global credit made that expansion possible. High interest rates attracted foreign capital, increasing dependence on external funding. And a culture of optimism made it difficult for critics to be heard. Each piece reinforced the others, creating a system that looked strong but was actually incredibly fragile. There were attempts to fix the system before it collapsed. Regulators introduced measures to monitor risk. Analysts raised concerns about the size of the banks. Some investors began to question the sustainability of the growth. But these warnings were often dismissed or delayed. And in a system driven by confidence, delay can be the difference between stability and collapse. When confidence finally broke, there was no time left to act. The system didn't fail gradually, it failed all at once. And that's what makes this story so important, because it shows that financial crises are not always slow-moving disasters. Sometimes they are sudden, unexpected, and nearly impossible to stop once they begin. In the years that followed, Iceland's recovery became a subject of global attention. The economy eventually stabilized, growth returned, and in some ways, Iceland emerged stronger, with lessons learned and reforms implemented. But the memory of those 3 days remains a powerful reminder of how quickly things can change. There are 3 key lessons hidden in this story. The first is that size matters, but not in the way people often think. Bigger is not always safer. When a financial system grows beyond the capacity of its underlying economy, it becomes harder to support in times of crisis. Iceland's banks were simply too large for the country to save. The second lesson is that dependence creates vulnerability. By relying heavily on foreign capital, Iceland exposed itself to external shocks. When global conditions changed, the country had little control over the outcome. Stability built on external funding can disappear as quickly as it arrives. The third lesson is that confidence is both the foundation and the weakness of financial systems. As long as people believe in the system, it can function even under stress. But when that belief disappears, even the strongest institutions can collapse. And perhaps the most unsettling part of this story is how familiar it feels. Rapid growth, rising debt, increasing complexity, and widespread optimism. These are patterns that have appeared in many financial systems around the world, which raises a difficult question. If it happened once, under these conditions, what's to stop it from happening again? Because the truth is, the collapse of Iceland's banks was not just a local event. It was part of a larger global crisis that exposed weaknesses across the entire financial system. And while reforms have been introduced since then, the fundamental dynamics, risk, leverage, and human behavior have not changed. So the next time you hear about rapid financial growth, rising markets, or new economic miracles, it's worth asking a simple question. What is this growth built on? Because sometimes the most impressive success stories are also the most fragile, and sometimes it only takes 3 days to find out. If you found this story insightful and want to explore more hidden financial histories, the financial histories, rises, the crashes, and the lessons they leave behind, subscribe and stay curious.